Getting started with investing is honestly one of the most powerful things you can do for your financial future. But let's be real, it can also feel like you're walking through a minefield, especially when you're just starting out. So, how do you actually navigate all of that and come out ahead? Well, let's get into it. So, just how big is this minefield we're talking about? Well, get ready for this number. In 2024 alone, financial confusion is set to cost Americans a staggering $243 billion. And that's not just the market going up and down. A huge piece of that pie comes from mistakes that are completely avoidable. The stakes, you could say, are pretty darn high. So, to get you on the right track, we're going to break this all down into three key parts. First, we'll dive into the psychology of investing, because, a lot of this is a mental game. Then we'll get into the nuts and bolts of building a real solid strategy. And finally, we'll pull back the curtain on some costly little oversights that can sneak up and wreck your progress. Okay, first up, mastering your own mindset. Because believe it or not, the biggest challenges for new investors are often happening right between your ears. And the first big psychological trap we've got to talk about is the rise of the finfluencer. Look, social media has made investment advice easier to find than ever before. But all that access, it comes with some serious hidden dangers. I mean, check this out. One study found that nearly 17% of investors, that's almost 1 in 5, lost money just by blindly following advice they saw on social media. And here's why. By the time a stock is trending all over your feed, the hype has usually jacked the price way, way up. That means you're buying at the peak. And those juicy insider tips, so often they're just paid ads or somebody's wild guess. So here's the most important takeaway for this one. Stop chasing tips and start doing your own homework. If you see a hot tip, fine, use it as a starting point, not the finish line. You've got to understand the actual business behind that stock symbol. All right, the next mental hurdle is an absolute classic, letting fear and greed grab the steering wheel. It's totally normal to feel your stomach drop when the market dips, right? But acting on that feeling, it's kind of like handing the keys to your financial future over to a screaming toddler. And this slide really shows you the two paths you can take. Over on the left, you've got emotional investing. That's your panic selling during a dip, which, by the way, just locks in your losses, or chasing some hot new thing out of pure FOMO and buying at the top. But on the right, you've got disciplined investing. And what's that about? It's about patience. It's about logic. Our whole goal here is to get from that left column over to the right. And if you need any more proof, just look at these numbers. Data from Hartford Funds shows that over a 30-year span, if you just stayed in the market, you got the full return. Great. But if your emotions got the best of you and you pulled out and you missed just the 10 best days in the market, your total return was cut in half. It just proves that old saying, time in the market is so much more important than timing the market. Okay, so we've gotten our heads straight on the mental game. Now let's talk about building an actual strategy. Because a strong mindset is awesome, but it's not much good without a real plan to back it up. And the first big strategic mistake, and it's a huge one, is just investing without any real goal. I mean, it's like buying a train ticket without knowing where you're going. If you don't have a destination in mind, how on earth are you supposed to pick the right train? This solution here is actually pretty simple. You need to define your why. Literally write down your goals. Are you saving up for a house in, say, 3 years? Or is this for retirement in 30 years? Every single goal needs a timeline, because that timeline tells you what kind of investments to pick. Stocks, they're fantastic for long-term goals, but you probably wouldn't put your 2-year house down payment in them. This plan, this becomes your anchor. It's what keeps you steady when the market gets choppy. All right, next strategic mistake, putting all of your eggs in one basket. It's so easy to get really excited about one amazing company and just pour all your money into it. But when you do that, you're basically betting your entire future on a single roll of the dice. This is pretty much what that looks like. A super high-risk, completely non-diversified portfolio. If that one company stumbles, your whole investment is in serious trouble. And get this, about 1 in every 4 Americans doesn't even know if their portfolio is diversified or not. That's kind of scary. Now this, on the other hand, this is what we want to see. This is a diversified portfolio. Your money is spread out across different sectors, different industries, even different countries. So if one area has a bad year, the others can help pick up the slack. And for beginners, the absolute easiest way to do this is with low-cost index funds or ETFs. It makes diversification super simple for anyone.
Okay, and for our final section, let's talk about the silent portfolio killers. These are those little practical details, the mistakes that are really easy to overlook that can just quietly eat away at your money over time.
So let's talk about one of the biggest silent killers of wealth: fees. I know, a 1% fee here, a $5 commission there. It doesn't sound like a big deal. But trust me, over decades, those little fees can add up and just devour a massive chunk of your potential earnings. So here's a term you absolutely need to know. It's called the expense ratio. It's basically the annual fee that a fund charges you, and even a tiny, tiny difference between two funds can add up to tens of thousands of dollars over your investing lifetime. The rule of thumb here couldn't be simpler. Lower is always better. You gotta read the label before you buy.
Next up, we have the terrible twins of bad investing: trading way too often and, even worse, using money that you've borrowed to do it. And here's exactly why this is so dangerous. When you're constantly buying and selling, you're just racking up fees and creating tax bills, and it almost never leads to better returns. But using leverage, that's borrowed money, is way riskier because it multiplies your losses too. If the market turns on you, you can lose more money than you even put in. So what's the solution? Stop checking your portfolio every day. Set a plan, look at it maybe once a quarter, and just give your investments the time they need to do their thing. And our final mistake, well, this one might sound a little silly, but you would be shocked at how common it is. It's putting money into an investment account and then completely forgetting to actually invest it.
Oh yeah, it happens all the time. Money gets moved into a brokerage account or a 401k, and then it just sits there. It sits in a cash settlement fund, earning basically nothing. So here's your super simple 3-step check. 1, fund the account. 2, choose your investments. And 3, and this is the crucial part, confirm the purchase. Make absolutely sure your money is out there working for you. So let's wrap this all up. Being a successful investor. It isn't about being some kind of Wall Street genius. It's really just about being disciplined. Do your own research instead of following hype. Control your emotions. Diversify your investments. Keep your costs as low as you possibly can. And always, always remember that investing is a marathon, not a sprint. You know, by just avoiding these 7 common traps, you're putting yourself on a much, much stronger path to building real long-term wealth. Which kind of leaves us with one last question for you to think about. What's the single best piece of investing advice you've ever received? Happy investing, and we'll see you next time.